In this video, we're going to go through examples for Chapter 9 for business finance. So in Chapter 9, we talked about how to calculate the incremental cash flows for a project in order to do the capital budgeting assessment that was covered in Chapter 8. So we're going to look at information and then calculate. So in this first example, we want to know what the total initial cost of this project is. So we have information about land purchase. We're going to build a new manufacturing plant. We bought land 6 years ago for $5.3 million in anticipation of this building. The land's market value is currently $7.7 million. We are going to build a plant that is going to cost $29.3 million to build. The site requires $1.41 million worth of grading before it is suitable for construction. And so what is the proper cash flow amount to use as the initial investment in fixed assets when we're evaluating this project? So let's look at each one of these step by step. The purchase price. The purchase price happened 6 years ago. That is money we have already spent and we can't get back. So that would be considered a sunk cost. However, the appraised price, the $7.7 million, that's an opportunity cost because that's money we're giving up if we decide to build on and use the land. We're losing that opportunity to sell the land for $7.7 million. The cost to build the manufacturing plant is relevant to this cost analysis, and the grading cost of $1.41 million in order to prepare the land for construction. So when we're looking at these, our total initial cost of this project is the appraised value plus the cost to construct plus the cost to prepare the land for instruction. So the total initial cost of this project is $38,410,000. In our next example, we're going to build a pro forma income statement to calculate what the projected net income is of this project. So we have information about our projected sales, our costs, and our tax rate. And we can use all of this information to build an income statement. So we have sales of $635,000. If I put equals here, instead of just typing in $635,000 for the cell reference, remember when I talked about in the lecture that if I wanted to change those sales to $650,000 and see how that affected my cash flows, then I could do that up here and my income statement will reset. My variable costs are 40% of sales. So we'll take sales times 40% to get our variable costs. And then our fixed costs are $168,000. And our depreciation expense is $83,000. Earnings before income and taxes are sales minus the total of all of our costs. And our taxes are 23%. We'll take our earnings before income and taxes times our tax rate of 23%, gives us our taxes of $29,900, and net income is earnings before income and taxes minus taxes. So the net income from these projections is $100,100. In this example, we're going to calculate what our operating cash flow is from this project and our depreciation tax shield. So first we can build our projected income statement with our sales, costs, and depreciation expense. The earnings before interest and taxes is sales minus all of our costs. Our tax rate is 21%. Earnings before interest and taxes times the tax rate. So our tax expense is $20,139. Our net income is earnings before interest and taxes minus the taxes. So we get net income of $75,761. So our operating cash flow, if you remember from chapter 2 and also discussed again in chapter 9, is the earnings before interest and taxes, or EBIT, plus depreciation minus taxes. So EBIT plus depreciation minus taxes. The other thing that we want to calculate here is what is called the depreciation tax shield. So this is how much the depreciation is saving us on taxes. That is calculated as the depreciation expense times the tax rate. So we have our depreciation expense of $94,500 and a tax rate of 21%, which gives us our depreciation tax shield of $19,845. In our next example, we're going to calculate the annual depreciation amount and the end of year book values for a 7-year property under the Maker's IRS tax depreciation values. So this is the accelerated tax that we can use. So we have our beginning book value of $745,000. So when we begin the project, our book value is $741,500. Let's do the whole depreciation allowance first, because in Maker's depreciation, you take the historical cost of the equipment times the depreciation percentage. So we never change the cost times that we take times the percentage. The percentage changes to change our depreciation rate every year. So we're going to lock that amount and then take it times the depreciation percentage. That way we can copy our formula down. I'm going to copy our formula down, and now we have the depreciation allowance for our entire 8 years. Then we're going to take our book value, beginning book value, minus the annual depreciation to get our ending book value. And I'm just going to copy that formula down. And now I'm going to fill in our beginning book value, which equals the ending book value. And I can also copy that formula down. And so now my Makers table is set up, and I can use this information to do a full cash flow analysis for the 8 years of the project, because I have my depreciation expense, which I need to calculate my operating cash flows. In this example, we're looking at an asset that costs $635,000 and has straight line depreciation over its 8-year life. We're going to use it for 5 years, and then we're going to sell it for $105,000. We have our relevant tax rate is 22%. So we're going to try to look at what is the after-tax cash flow from the sale of this asset. So first, we need to know what the annual depreciation is. So it's straight line depreciation over 8 years, which is our asset price divided by its useful life. Then we want to know the accumulated depreciation that we're going to have at year 5 because we need the book value at year 5. So we need to know how much depreciation accumulates in 5 years. We're going to take our annual depreciation times the years the asset is used. Our book value, remember, is asset price, historical cost, minus accumulated depreciation. Now we can calculate our after-tax salvage. So the after-tax salvage is the sales price of the equipment, which here is listed as market value. We're going to sell it for $105,000. Sales price plus the ending book value minus the sales price times the tax rate. So we have the sales price plus ending book value minus the sales price times our tax rate of 22%. So the after-tax salvage value of this equipment is $134,287.50. You can see we actually get a tax shield from that because we're selling it for less than the book value. So we would be taking a loss on it, which gives us a protection from taxes. In this example, we're looking at taking on a new product line. So we are a company that sells soundboards. We're going to sell a new soundboard. We expect to sell 1,500 a year at $26,400. We currently sell 1,850 units of our existing model. If we introduce a new model, the demand for our old model is going to decrease. So when we look for the cash flows, we have to take into consideration that we're going to lose sales. So we're going to have those lost sales from our current board. We have to think about that. So we have all of this information about the project, the cost, the cash flows, and we're going to calculate what is our annual operating cash flow for this project. So we're going to lose sales from our current board. So we're going to go from 1,850 to 1,520. So we're going to take those minus each other. So we're going to lose sales of 330 on our old board. So that becomes one of our costs. It's cash flows that we're going to lose. So first we have the sales of our new board. So we've projected that we're going to sell 1,500 boards at, so times, $26,400. We then have our loss of sales from the old boards. So we have that we sell our old boards for $24,900 and we're going to lose 330 of them. So we have lost sales of $8,217,000. Next are our variable costs. Our variable costs are 55% of sales. So we take our sales times 55%. So our total sales times 55%. So the net sales of the new plus the lost sales times our 55% variable costs. Our fixed costs are $2.9 million. That doesn't change. And our depreciation is $1,875,000. This gives us earnings before taxes. So we have the sum of our sales minus the sum of all of our costs. So total revenues minus total costs. gives us earning before taxes. We then take that times our tax rate of 22% to get our tax amount, subtract taxes from earnings before taxes to get our net income. We then calculate operating cash flows. So operating cash flows are EBIT, earnings before taxes, plus depreciation, minus the tax expense. So the operating cash flows from this project are $9,165,933.